You've probably heard about secular bull markets like the 1990s or secular bear markets like the early 2000s. Secular just means long term. Well, here's what I think might happen next. We may not get a secular bull market or a secular bear market. Instead, we might face secular volatility for the coming decade. Think of it as a very rough ride, sharp rallies, sudden drops, confusing headlines. The market may swing up and down and just go sideways instead of steadily heading anywhere for very long. We've seen this movie before. It's called the 1970s. Now, I can't predict what the market will do, but I can help you prepare for what might come. Let me walk through 4 models and why they say that 2025 to 2035 could turn out this way. Then we'll talk about what you can do. Case number 1, the historical model, interest rates and inflation rates. Picture this. It's the mid-1960s. LBJ has 2 wars, one in Vietnam and the other one here against poverty, and they're driving massive spending. Deficits are starting to balloon. LBJ pressures Fed Chair William McChesney Martin to cut rates. Can't have a recession before the election. Then Nixon comes in, faces the same pressures, leans on Arthur Burns the same way. Lower the rates, forget about inflation, help my re-election. In both instances, the Fed caved to the unrelenting political pressure. Inflation simmered for years, but eventually it exploded, hitting 12% by the mid-70s and staying elevated for about a decade. Now look around today. Massive deficits? Check. Public frustration with high borrowing costs? Check. Political pressure building on Jerome Powell to ease rates? Check. Same script, different cast? Here's what history teaches. When the Fed cuts while inflation still runs warm, you usually get more inflation, and it sticks around longer than anyone expects. Stock prices love low inflation, but get hammered when inflation heats up. Case number 2, the generation model, the fourth turning. In 1997, 2 historians published a book that can shape how we might view our current moment in history. William Strauss and Neil Howe wrote The Fourth Turning, which mapped Anglo and American history into cycles of roughly 80 years, each divided into 4 turnings or generations. Their pattern goes like this. First, the high. That's the cycle in the part of the period that post-crisis rebuilding and prosperity. Then there's an awakening, a time of spiritual revival and social upheaval. Next, the unraveling occurs. Institutions weaken, cynicism and distrust grows, and finally, a crisis erupts, when all societal and institutional pressures that have been building for years explode into a major conflict and reordering. The cycles played out before, and these were the 3 most recent crises climaxes. 1780s, completion of the American Revolution. 1860s, the Civil War. 1940s, World War II, right on the heels of the Great Depression. Each time, these were about 80 years apart. By the author's math, we entered the current crisis phase around 2008, and it'll last about 20 years. The climax, probably late 20s or early 30s. Look around. Growing polarization, institutional mistrust, international tensions rising. Markets hate uncertainty. During crisis periods, they swing hard both ways. Rallies followed by sharp setbacks. If Strauss and Howe got the timing right, the next few years could feel like the storm before a new calm. Case number 3, nation-state life cycle model. Ray Dalio built the world's largest hedge fund by studying patterns others miss. One discovery has haunted him. Empires follow predictable cycles. They're born, they grow powerful, then all great powers crumble under the same 3 strains: debt, divisions at home, and challengers rising abroad. Take Britain in 1914. Massive debts from past wars, social tensions bubbling, and Germany challenging their dominance. By 1945, the British Empire had collapsed, the pound was devalued, and America had taken the throne. Dalio looks at America today and sees the same 3 strains building. Record deficits pile higher each year, Political divisions deepen, and China rises in the east, testing American resolve. When countries can't pay their debts honestly, they print money instead. Devaluation becomes the relief valve, but inflation becomes the price. Dalio's model suggests the next decade will bring more currency instability, uneven growth, and rising chances of conflict. Empires don't decline quietly, and markets rarely deliver steady gains during the transition. Case number 4, the total returns model. Ed Easterling runs Crestmont Research from a small Oregon town, but his math explains price action better than most Wall Street analysts. He discovered something elegant in the data. Long-term stock returns come down to just 2 things: earnings growth and whether people are willing to pay more or less for those earnings. You can see the PE ratio as the golden line on the chart. Here's one of his most insightful discoveries. The price investors pay determines almost everything about their investment performance over the next 10 to 20 years. Pay too much when the PE is very high, get poor returns for the next 10 years or so. Buy cheap when the PE ratio is low, you'll do well in the next decade. Right now, investors are paying prices near the highest in history for stocks. PE ratios tend to increase for 10 to 15 years and then they decline for 10 to 15 years. You can see the cycle repeat on the chart with the biggest peaks in history: 1929, the late 60s, and 2000. Maybe you experienced that one personally. Now, a 10 to 15 year declining phase for PE ratios doesn't mean the stock market just falls straight for 10 to 15 years, but it might fall or stay pretty flat for the period. After the 1929 peak, the market declined and did not reach break-even point for 25 years. For the 11 years after the 1969 peak, the market stayed below that peak level for all but a few quarters. After the dot-com peak in 1999, the market declined, recovered to the peak, declined again, and then recovered again. 14 years passed before the market retook the 1999 peak. Easterling's models suggest that passive investors today will likely face a frustrating decade ahead. Not necessarily losses, but returns that disappoint after you account for the inflation and the amount of time that passes. What this means for you. These 4 lenses, these 4 models, strongly suggest the following phenomenon coming up: federal government policy whiplash, social stress, late cycle debt dynamics, declining valuations starting in the near term. All of those point to the potential for secular volatility for the foreseeable future. For anyone approaching retirement in the next 10 to 15 years, this stuff really matters. A simple passive plan like buy and hold might leave you with negative real returns, that is, losses after inflation are accounted. Worse, you might be experiencing steep drawdowns when you can least afford them, like when you need to take some money out of your accounts for covering expenses. So what can you do? You can't control the markets, but you can prepare for multiple scenarios. Okay, let's look at what smart money does. First, it looks backwards. Pull up charts from previous periods of turmoil. See how stocks, bonds, and other assets performed during the 1970s stagflation or during the 2000s roller coaster. History does not repeat, but often it rhymes. Next, set your rules before the storm hits. Decide when you'd reduce market exposure and when you'd lean back in. Do this now before the headlines get bigger and the emotions get even bigger. Let the rules decide, not your gut. Experienced investors also shorten their planning horizon. Instead of set it and forget it strategies, they check and adjust more often when conditions get choppy. Stay aware of changing weather. Spread your bets beyond the obvious. Include assets that zig when stocks zag. Things that respond well when inflation jumps or when markets drop. For example, gold did really well during the 1970s. Even though it's risen quite a bit lately, more inflation might keep it attractive for some time to come. Now, 20 years ago, diversifying your investments across asset classes often meant calling specialized brokers. Now you can do it easily through ETFs. Experienced investors size their positions so no single disaster ruins the plan. Even if they're wrong about one big position, it doesn't threaten their lifestyle. You can minimize surprises by managing what you can control. Finally, experienced investors keep some powder dry for opportunity. Cash feels boring until there's panic in the streets. If you hold some cash, then you're not forced to sell anything at major lows. Instead, you're prepared to pick up some bargains, potentially at once in a generation price. The takeaway. The decade ahead may not reward passive approaches like buy and hold or target date funds. If we do see secular volatility, it has better potential to reward rules-based systems that adapt when conditions change. That's the framework I think gives investors a better chance of surviving volatility and still reaching their goals. Look, we don't know, I don't know exactly what's coming. And maybe I'm wrong about all of this. But when you notice storm clouds approaching, preparing for rougher weather just makes sense. You can't predict the market, but you can prepare for what could happen. In future videos, I'll go deeper into each one of these models and show some practical steps that you can take. Well, that's the big idea I wanted to share today. I am not a licensed financial advisor, and nothing in this video constitutes investment advice or is a recommendation to buy or sell any securities. Past performance doesn't guarantee future results. This content is for educational purposes only, and you should consult with a qualified professional before making any investment decisions. Please see my full disclaimer statements here.